I'm Chanchal Agarwal from Eastern Financiers, and today we'll be discussing on our next thematic play on IT sector. And we are not discussing rupee depreciation. That's just one part of why, of course, IT looks good. But let's look at how the fundamentals around this sector has evolved since the pandemic era. Let's take two step backs to understand what happened during the pandemic era, right? During the pandemic time, we saw a lot of employees quitting their stable IT jobs to either join their own startups, or to join a startup which is into cryptocurrency, Web3, blockchain, so on and so forth, right? So it's the whole narrative around the FANG stocks, etc., started diminishing, and people wanted to do something new. Everybody had this thing that world is maybe going to change, and it's better to adopt that change. That was one part of it. Second part was, of course, the salaries, the ESOPs, etc. Right? The increments were in the range of 200 to 300x plus. There's this whole ESOP package that people got loot to. To give you one data, and this is really interesting, there's this data by Randstad India which says that for every IT professional, there is 2.5 offers that he has in hand today. So imagine the kind of gap that is there between the demand and supply, and which is pulled these, or made it lucrative for these people to join the tech sector. And the $227 billion IT industry has been struggling to retain their employees because of these high attrition number. Just to look at the numbers, the attrition numbers are over 38%. So 1/3 of the employees who are employed are actually, or have actually, quit their stable jobs and have looked at various new lucrative options. Couple of major companies have declared their results, and the numbers are really surprising. So, for example, Infosys has reported a attrition of 27.7%, which is huge. Somebody like Tech Mahindra is at 24%, and that's kind of affecting their margins. I think Tech Mahindra has declared their annual results about 2-3 days ago, and the margins have shrunk, and it's shrunk by almost close to 2%, and they have admitted that margin pressure is there because, of course, there is attrition. So you need to employ new people. Either they could be freshers. There's a whole lot of training that goes in getting that people to shape, which is somewhere getting culminated into their numbers. Now, this is the story of the past, and this is what has been affecting these companies. But let's look at what has changed in 2022. And 2022 has been a great year, full of volatility, right? We have seen some of the biggest names crashing down. Let's go back and understand what's happening globally. So somebody as big as Tiger Global, and everybody swore by this hedge fund. They have lost 2/3 of the gains that they had made since 2011, since 2001 when they started off, right? That's huge. The reported losses are around $17 billion this year. Another company that comes to our mind is SoftBank, right? We've seen SoftBank invest across all large tech funds, including India, right? A lot of money has come to India from SoftBank. It's reached a stage where people are now questioning the ability of management to identify good companies. They are seeing huge losses coming up. I think their reported numbers are somewhere around $18.6 billion of losses, right? Let's come back home and see what's happened to our entire tech industry, right? And the first name that comes to our mind is Paytm. All of us have been through the entire journey of Paytm, where in the unlisted market we saw numerous numbers coming in for and people just waiting to get hold of this share. But what happened after it listed off, right? If numbers are to be believed, almost 65,000 crore of value got wiped out in Paytm. Similar stories there for Zomato. Zomato almost saw 2/3 of the investor wealth being wiped off since its peak in November. That's huge a number to look at. Another company, PharmEasy, right? This was the most spoken about stock, and people were waiting in the unlisted market to get a hold of this share. It's lost almost 50 odd percent since last quarter. That's huge a number to look at, right? And why is this? I mean, why is this happening? And there are numerous reasons, and people are blaming the G-Sec curve or the US Fed for it, saying that the yields are increasing, so money is moving back to risk-free asset. So let's leave the reason aside, but what happens when this happens, right? What happens when the private equity is seeing losses? What happens? I mean, the first thing whenever a private equity is seeing losses is it would obviously invest less into the underlying companies that he has in its portfolio, right? And all of these companies are now dependent on the private equity capital to meet their working capital requirements, to expand, so on and so forth, right? So what will happen to these people? What will happen to these people who are now no more working with these established large IT organizations and have moved to these lucrative tech startups? Will the startups still be able to absorb such high cost? Will these guys still continue working there? How will the funding work off? There is an interesting change that has happened. There's a new trend that we are seeing coming. So from November of 2021, there's this chart that we have used in our report, which says that the new employee laid off from these new startups have started an increasing trend. Yes. So this is one pointer that comes to our mind, saying that, whenever capital or whenever liquidity vanishes, the first thing happens is you start with a layoff, right? But one may question that this is US, right? I mean, that's US Fed increasing rate. There is a slowdown in US. So, I mean, that's their economy. Back home, our economy is safe, right? Because India is still a growing country and there's just a lot of opportunities. Let's look at our numbers. There is an interesting report by Business Insider which says that Indian startups in the past 4 months have laid out 5,700 employees. Now, that's a big number to look at. And you have a whole lot of numbers coming in, right? So, I mean, likes of Unacademy has laid off almost, reports are to be believed around 1,000 odd employees, 1,200 odd employees. Furlenco has joined them, Trell has joined them, Misho has joined them. Now there is this increasing trend which has startup with, say, huge large startups where the valuations are around 100, 150 odd millions. But if the larger guys are doing this, will it take time for this to spread over to the entire smaller startups? Maybe yes. Maybe in the next 6 odd months we might see this trend passing across all startups. Now another one that's come off, it says that Swiggy. So Swiggy had started this services which was largely on grocery and daily essentials in 6 odd cities. Barring Bangalore, it is shutting down this service in the 5 odd cities. And the reason the company has given is that they want to right size the organization, right? Of course, that will be with the whole corporate staff, with the whole delivery staff that they had employed for this project. I think they would have to obviously lay them off, right? So that is one way of downsizing the entire organization. Second thing which is very typical with these tech startups is, of course, the culture, right? And BharatPe has been one example around this, where there is a difference between the culture that these organizations follow versus the established ones, right? So this is what is happening today, where these startups went into a fire hiring, and the motto was all around growth at any cost. So what's for the future, right? I mean, if they hired in the past 2 years and now the liquidity conditions are not that great, of course this will be followed by a layoff. Now think about it. If an IT company employee is getting laid off from a tech startup, where will he go? Obviously, he will go back and find stability. Where is he getting the stability? amongst the established names. So we think that all these employees who left in the past 2 years might come back to the alma mater, might come back to companies in the top listed IT space, and that will give this beneficial advantage to these companies, where now they are the choosers, right? So they can pick and choose, they can manage their salaries well, and that will in some sense get back help them get back their margins, right? So this is the whole thematic play that we believe that could play out in the IT sector for the next couple of months, and it makes sense for someone to start building a tactical exposure towards, by way of MFs on this. In our note, we have listed 4 different schemes that you can look at, and it's best to look at about say 2 to 3 years, where you can thematically and systematically build exposure on these names. Thank you, and stay tuned for this.